You're listening to The Capital Table. Private capital markets have been evolving for many years, but never more so than in recent times. Take a seat at the Capital Table with leading experts discussing insights into the private equity and M&A worlds, and take away the knowledge you need to excel in a rapidly changing marketplace. We know this is one table you'll leave feeling full and satisfied.
Hello, everyone. Welcome to this episode of The Capital Table. Super excited to dive into a really important topic today, transfer pricing, as we start a two-part series. This part today will overview transfer pricing and the impacts and issues around M&A transactions with transfer pricing. Super excited to welcome today Marina Gentile, my partner, who leads our transfer pricing practice, and Boris Pogel, senior manager with the M&A tax team here, as they talk about the overview of transfer pricing and M&A. And then when we go to part two, Marina will rejoin us. We'll dive into the impact and intercorrelation of the transfer pricing issues and tariffs and what's going on as the world tries to address the tariff issues and deals right now.
Great. Happy to be here. Love talking transfer pricing. Have been doing it for the last 30 years. So taking it into the transaction advisory space has been an adventure. It's very relevant now, where maybe it wasn't even a few years ago. So happy to be here.
Great.
Hey everyone, Boris Pogel here. I'm one of the M&A tax leads here with them. Transfer pricing is a very interesting topic, so I look forward to speaking with Steve and Marina about this.
Yeah, so welcome to you both. And again, this will be the first of a two-part series. We're going to dive into a lot of the technical stuff, or common English technical stuff in this episode, and then get into some interesting dynamics in episode two. So let's start off, Marina. First of all, tell us what transfer pricing is and how active it is as a part of tax diligence for global businesses.
Yeah, great. Thanks, Steve. I always like to level set and give the, 1 minute primer on transfer pricing, right? Basically, global companies cross-border transfer of four things. One is a physical, tangible good. 2 is some kind of service. 3 is a licensing royalty arrangement. And 4 is financing, a loan, line of credit, et cetera. This is where the transfer pricing regulations come into play. They're out there. Most people aren't necessarily aware, right? These are kind of very technical, dry regulations. Every country has them. At the end of the day, the tax authorities are looking at pre-consolidated profit for the company and making sure that their profit or loss is in line with the functions they perform, the risks they incur, and then any intangibles. So either, any assets. So either tangible assets or in particular intangible assets, right? So that's kind of the baseline of transfer pricing. It definitely comes into play in the diligence space, overall, right? I mean, buyers need to know what they're buying, and so how healthy the company is. Transfer pricing is the biggest tax uncertainty for multinationals, so we got to see if there are any skeletons in that closet and kind of kick the tires on that before acquiring the business. And then the target company should be ahead of the game and prospectively trying to set up their business in a way to make it more attractive, and having transfer pricing in mind. However, it gets sort of neglected often. So that's why, it's really good to talk about.
Yeah, absolutely. And Boris, I guess from your perspective, leading our diligence efforts on, the clients we're working with, have you seen the same thing over time, that this is becoming more and more an important topic to address? We know it is. The point is getting our clients to understand that, which many do and many don't.
Right. Absolutely. I think with, our latest transactions, there's a lot of cross-border considerations, a lot of U.S. entities that interact with non-U.S. entities. So I think, one of our focal points of diligence is usually, assessing those transfer pricing considerations. Some of the common things that we've been seeing recently, Marina, I think are management fee deductions, right? So,
Yep.
you would have a U.S. entity paying a substantial amount of management fee deductions or expenses to a non-U.S. entity and kind of shifting expenses and potential profit between, a high tax jurisdiction to a low tax jurisdiction. So that's something I think we've been seeing a lot of lately. Also with respect to R&D expenses, right? Sometimes, we need to figure out, are the appropriate R&D expenses being taken into appropriate jurisdiction, right? And not just
Right.
for, income shifting purposes.
Yeah, absolutely. And I think that, these companies are at a disadvantage, right? Because the tax authorities just assume everyone is manipulating internal pricing, transfer pricing, right? To minimize profits. And the truth is, people are just trying to run their businesses, right? And this is just some kind of very esoteric thing that nobody's really thinking about. So I think it's just important for us to dig in. So that management fee you talked about, right. It needs substance, right? Is it a real management fee? Everyone can say management fee, but does it make sense, right? Is the amount in proportion to the services being provided? And are the services really being provided, right? So going out into the marketplace and discovering with the company what the services are, and then benchmarking that it's market rate pricing is really important.
Yeah, absolutely. And certainly as we drill into this, well, peel that onion back a little bit further and some of the interesting things that you've addressed over your career, Marina and Boris, we're seeing on the diligence side, working with Marina and her team. But I think, stepping back, if you look at a potential transaction, buyers and sellers want to make sure there's a smooth transition, whether they're on the buy side or the sell side, or it's a merger. And, certainly in that immediate sense, making sure the deal gets closed. So from your experience, what kills or delays closing the deal the most when it comes to the topic of transfer pricing?
Yeah, you see it repeatedly. What it is. It's always the same thing, right? One is the intangibles, right? What they are and who owns them, who has the rights to exploit them, right? Where they're located. That is the biggest thing, because probably the name, intangible, right? Hard to identify. What is it? What's your secret sauce? What is your competitive advantage in this business? And a lot of times that gets lost along the way, and so the reason it's important is whichever entity owns the intangibles is that's the entrepreneur of the business, right? So they ultimately get the higher profit of the global business, but initially, of course, incur the additional costs of that business as well as they're trying to develop this. So kind of intangibles are king, and we want to know where they're located and who's been funding them and, how they get exploited, because profit travels that. The next is compliance, right? So if they've done any transfer pricing compliance, some countries, it's an obligation to do it every year around the time of your tax return filing. And so we want to make sure that that is done. And also that the transfer pricing matches the intercompany legal agreement that matches the accounting, which is really the substance of, what you're doing, what the company is doing. And oftentimes we dig deep into a company, or maybe not even that deep, and there's a disconnect between those three things when they should be matching. They should be, absolutely the same. And then I would say a third thing is we see a lot of tax havens as we go through structures. And I think that there's, we see tax havens with not a lot of substance, right? And so that's another one that just sort of puts the structure at risk, because, there's, we talk about two guys in a boat in an island, somewhere with 0% tax rate, and that just doesn't drive the business or the intangibles. So the profit should match what is happening there, substance wise.
Yeah, absolutely. And, let's look at this from the perspective of the buyer. Switch gears a little bit. As you've both talked about, doing diligence around transfer pricing is critical. It's getting a seat at the table now, whereas Marina, I think your comment was a few years ago, it wasn't that big of a seat anyways. So
Right.
you're obviously seeing that transition, but again, from the buyer's chair, what should they really be looking for?
Yeah, so they need to assess a global business for these things, right? One, do they have any compliance? So they're asking, one, do you have a transfer pricing policy? And what are you doing? How are you interacting with each other? Two, do you have an independent, report, right, from an advisor that's showing you, hey, this is market rate as benchmarked, and so they're kind of supporting what's happening because two related parties cannot negotiate a market rate or arm's length transaction, right? So that will get unraveled quickly. You need to have that like independent viewpoint of it, of the scenario. So that's the big thing because 45-day close or whatever ends up happening, they're left holding the bag. So they need to know what the risks are. And as I mentioned before, transfer pricing is, without exception, the largest tax uncertainty for any multinational company, right? So they need to know what's there, and because the position is volatile, and they could be left with, penalties, fees, in an audit situation by a tax authority in a country they know, nothing about, except they just, bought this business that has a sub there or whatever. So that's critical. Do your homework and get that as part of the diligence to make sure that somebody's taking a deep look.
Right. So as a buyer, you're identifying these issues. What is the right time to, address these issues? How do you address them up front? How do you transition that into after the deal closes?
Yeah, well, ideally, the target company has their ducks in a row with transfer pricing. But if not, then it does need to be addressed during the before close, right? It needs to be sort of assessed. What is the impact? Transfer pricing, for example, in the US, there's the risk of an income adjustment, right? That then gets you into a double taxation situation because you've already paid your taxes in one country or other, and now you're getting, the revenue adjusted, let's say to the US, and then you have penalties that could be 20% or 40% of that adjustment. So those can add up, those numbers, right? Penalties, interest, right? So just get a number around it, get an estimate around it. So sometimes that involves doing some analyses to see, actual numbers. And sometimes it involves, let's ballpark. The numbers aren't big enough to actually have to dive in and to do the whole analysis. But, I've seen buyers, adjust the purchase price based on, not coming to terms, and not getting clarity on transfer pricing, or the risk is too large. And I've also seen it delay closes, as well as sort of having the contingencies in place, right? If something comes up within X amount of time of close, the target is, still on the hook for it. So.
Right.
And Marina, sometimes, the seller may not want to reduce a purchase price, right? If there's an identified transfer pricing issue. Have you seen times where the sellers would be okay with maybe a potential holdback or an escrow? Whereas, after a certain period of time, that money may be released if there's no type of audits related to transfer pricing. Have you seen anything like that?
I have. Yeah, I had. And that's the more common than actually, adjusting a purchase price, is to having some kind of escrow, contingency plan, just to get through the audit cycle years, and then they're clear after that.
Right. So let's look at it from the perspective of a seller. Obviously, these issues can be important to a buyer, and again, going back to the overall premise, everybody's trying to get a deal done. So the seller wants to get a deal done, and thinking this through and making sure their house is in order, so to speak, well before a transaction happens. I mean, what's the right time for a seller to look at this?
So there is It's never too early to look at transfer pricing. I work with, as you know, Witham has a large tech practice, right? I will work with pre-revenue tech startups to establish clean, solid transfer pricing that then is scalable with the business, right? And it's critical because what's going to happen is, sure, you're in loss years forever and nobody seemingly cares about transfer pricing. But the truth is, if you don't get that right, you could have NOLs that are in jeopardy, right? Like it's a profit and a loss discussion with transfer pricing. So once they have revenue, then they're looking for, and they're commercializing the product, they're looking to have the profit go back to the intangible owner that had those losses to begin with, right? That just makes sense. Whoever invested in the technology or API or whatever it is, depending on the industry, should gain from commercializing it more than other people, right? And so to me, you just set the business up for success and you protect your assets from the beginning. So the tax piece of it, but also, you want to make sure that you're telling the story of your business. And the story is, this is the entrepreneur. It's located in this country. It funds all the development. It owns all the intangibles. So then the other tax authorities, that you're dealing with, whether you're selling something or if you have a contract R&D shop somewhere, it needs to be clear through the transfer pricing that that entity is a service provider to the entrepreneur, right? So they're not building intangibles with that 50-person team in India. They are simply providing the service of development to their intercompany parent in the US. And if the transfer pricing is wrong, because I hear a lot like, oh, well, India is a cost center. Well, there's no such thing as cost center in transfer pricing, right? India should not be absorbing any risk related to development because they're not going to gain any profit from owning from that intangible. They don't own it and they can't market it. So it's getting that right is critical. Otherwise, you've got then the India very aggressive tax authority coming after higher profits because, they ultimately funded intangibles because the company didn't get the transfer pricing right,
Right. Yeah, and certainly we've seen, as you touched on, these issues very prevalent in technology companies. They tend to operate globally just by the nature of how they come together and having contractors or employees around the globe. Not that it's exclusive to technology, obviously, but we've certainly seen some very interesting intangible property issues in that industry as well as others. So
absolutely.
Well, let's look at, as we round out this episode, all this leads into the post-acquisition structure for the buyer and what they're addressing as part of this getting the deal done phase of the transaction. So, Marina, what's your recommendations there, and certainly some of the key issues to think through on structure?
Yeah, that's a big topic. Definitely something I think we can cover more in depth in episode 2 as well. But that's the consideration, right? So now you have a business that was a standalone business acquiring or merging in with another business that was a standalone business, right? Both of them have some kind of intangible, pretty much by definition. They were attractive, as a target because they had something to deliver, whether that it's a technology, client base, marketing, a brand intangible, et cetera. So we need to be careful with that post-acquisition structure. That's actually where a lot of the work really comes into play, because if we're not careful, we turn that like simple transfer pricing model of one entrepreneur for the global business with then, other less complex entities. We could have multiple entrepreneur entities around the world. And it's never a good idea. It's just too attractive to tax authorities. It then goes to cost sharing arrangements and profit split scenarios, and nobody wants to be there unless they really have to be there. So, but to summarize, Steve, which I think is really sort of what we're talking about is, never think about it early enough, right? Like you just get it into place as soon as you're starting your business. Like you said, a lot of companies are just establishing globally. There's not even that globalizing aspect anymore. So getting it in place just, gets a cleaner structure from the beginning, and then it's scalable as your business grows. And then from the buy side, making sure to look at it, right? Like what does this company look like from this standpoint, and what's the risk? And then post close, let's do the work to really properly integrate it.
Right. So Marina, Boris, thanks for joining us today. Great discussion on transfer pricing. Really appreciate your insights. And Marina, we look forward to bringing you back in our next episode to dive further into the tariff issues. Thanks, everybody.
You've been listening to The Capital Table. For more information, please visit withum.com. Thank you for listening.